Good day, everyone, and welcome to our webinar. I want to welcome you from BAFT, and thank you to Marco Polo for co-hosting today's webinar. Thank you to our esteemed panel of speakers as well. We're very excited with the sessions we have lined up and have a record number of people register for this event. First, I want to call out some of the functionality of the platform. Everyone is muted to minimize any noise during the sessions. There's a box on your screen on the lower left corner. This box has a chat function, Q&A function. The chat function is used to message the conference team or other attendees. Please do not use that to ask your questions to your speakers. Attendees are to try to chat and let them type where they are joining us from, then mention, I see Arlene is joining us from Washington, D.C. No. Q&A, use the Q&A function to ask speakers questions during the session. Any unanswered Q&A will be included later at during the Q&A session. Once again, I would like to now turn to our webinar, Supply Chain Finance, What's New, What's Now, What's Next? Co-hosted by Marco Polo, featuring Bank of America, Crédit Agricole, and TradeIX, and moderated by John Pasquale, Senior Reporter at Global Trade Review in London. John covers all areas of international trade and trade finance, with particular focus on emerging technology, regulatory issues, and financial crime. Over to you, John.
Thank you very much, Stacey, and thank you to BAFT and to Marco Polo for the invitation to moderate today's discussion. As Stacey mentioned, I'm a senior reporter at Global Trade Review. As I'm sure you can all imagine, supply chain finance in particular has been a real area of focus for us over the last few years and months. Joining me today is Robert Barnes, the Chief Executive of TradeIX. Rob's trade finance experience started in logistics and financial technology, and before founding TradeIX, Rob founded non-bank supply chain finance provider Prime Revenue in 2002 and consultancy Aradia in 2007. Also joining is Dominique Honoré, who is Global Head of Transaction Banking Products at Crédit Agricole. Dominique joined the bank in 2015 as Global Head of Supply Chain Solutions and is now engaged in the transformation of its cash management proposition and defining the bank's product roadmap. And also joining me is Anne McCormick, the Director of Trade and Supply Chain Product Management at Bank of America, and leads the strategy and execution of the bank's global trade innovation, having rejoined the bank in 2011. She's also in charge of ensuring a globally consistent platform experience for all trade finance products. So as Stacey already mentioned, we're really keen to make this as interactive as possible, and we'll be leaving plenty of time for questions. So if there is anything at all you want to put to any or all of our speakers, then please do. You can use the Q&A box on the left of your screen. And don't worry about waiting until the end. Feel free to send questions in at any point at all. We'll get to as many of them as we can. Just in terms of definitions to frame what we're going to be talking about today, this relates to situations essentially where a buyer, so for example, a large corporate, is presented with invoices from their suppliers and approves those invoices. Generally, as you'll know, those invoices won't necessarily be paid straight away. There will be a period of time, say 15 days, 30 days, 60 days, really varies a lot between the invoice being presented and the invoice actually being paid. For suppliers, supply chain finance is a way of receiving that payment more quickly, freeing up working capital. And the way it generally works is a provider of supply chain finance, which could be a bank, it could be a non-bank fintech, it could be another type of investor. They will agree to pay those invoices early, typically at a discount, but not necessarily, and then collect payment from the buyer on the terms that originally agreed, so after 30 days, 60 days, whatever that might be. Now, in a lot of cases, there are, of course, variations or additional parts to this. Maybe the provider of supply chain finance might offer significantly extended payment terms, or so they can hold on to working capital for longer. But for the purposes of this discussion, we're just going to keep it to payables finance, so early supplier payments facilitated by a third party for invoices approved by the buyer. There's obviously a lot to talk about here, and in many ways it's been a pretty challenging year for suppliers, for buyers, for banks, for just about every type of company. We're going to start by looking at our speakers' experience in terms of demand and implementation of supply chain programs, finance programs, including how COVID-19 has changed demand. We're going to look at how that differs depending on where in the world these programs are being offered. And we're going to talk about the role that new technologies, so trade networks, digital solutions, and so on, the role they are playing in the provision of supply chain finance. So with that, let's get started. I'll start with a question for Anne, if that's okay. Anne, please, would you tell us a bit more about your experience just in terms of demand for supply chain finance and program implementation?
Sure, thanks, John. And as you mentioned, with COVID, it's an interesting and relevant question in 2020. But what we've seen is continued growth in supply chain finance demand across all our regions globally. Even with the pandemic, what we actually saw with other trade products potentially getting more impacted, we saw supply chain finance volumes actually continue to trend upward, because the clients really are looking for options for their suppliers, low cost financing, with a real emphasis on ensuring the suppliers can maintain some resiliency. So really important to the health of their supply chain, et cetera. We saw the growth in this product, obviously, with the impact of COVID had across all the global supply chains.
Great, thanks, Anne. And if I can turn the same kind of question over to Dominique. Dominique, have you experienced a shift in terms of interest from your clients? Is there a move to increase efficiency and the size of existing financing programs, for example?
So, good afternoon, everyone, or good morning. So definitely we see more demand in Europe, particularly in France. There is the LMA in France, which is restricting the payment terms. There were not so many interest years ago. Now it is really increasing, and we have a demand for programs which is completely new. We also see regain of interest for working capital solutions, the sustaining the supply chain. But we have different solutions between supply chain on the payable side, account receivable, and inventory financing. On the supply chain finance side, we have different schemes which are still prevailing at the moment. We have the white label solutions.
Thanks, Dominique. I'm not sure if everyone was experiencing some sound problems there. Sorry if so. It might be at my end though. Would you mind if I just went back to Anne quickly, just to expand on this point around the impact of COVID-19? So we heard from providers of supply chain finance, bank and non-bank, that there had been generally a significant increase in demand, as you explained, due to the pandemic. How would you say that demand has been met by banks?
Yeah, so what's been interesting about it is we saw where corporates were working from home, et cetera, the importance of the digitization, which trade has struggled with, supply chain probably more appealing offering in that so much of that was digital. There's not a lot of reliance on the documents and so forth. So, but really the flexibility in submitting to get new programs in, legal documentation and digital signatures, etc., was really key for our clients. The other thing that we saw is a good partnership with our clients to be able to provide solutions for their suppliers, be it if they, looking to go down market to the smaller SMEs where supply chain finance traditionally is focused on the strategic suppliers, but with a real focus on the supply chain, ensuring they can still, produce their goods, etc. There was a focus to partner to say, how do we make sure that we can maintain the financial stability of those suppliers by, going further down, as well as offering them flexible solutions with a lot of employees at home. So definitely been an interesting time, and where the supply chain finance product really showed how much of an important product it is for financing overall the global economies and the supply chains.
Great, thank you. And just staying with you for a minute, Anne, did you experience a difference in terms of interest and growth and provision of supply chain finance between different regions around the world?
Yeah, I would say it was pretty consistent. I mean, what we try to do at the bank is we look for solution, global platforms that can meet solutions for basically all the regions, and with that means that instead of having a lot of customizations, either be it for the buyer or for a particular region that meets the jurisdictional or regulatory requirements of those countries, is to provide, platforms that are flexible and more on the configurable side to meet those needs than the custom side. So with that, we really saw the expansion, pretty much across the board in all the regions, interest, because with trade, the interconnectability of the global economies, one buyer has suppliers, the buyer may be in the U.S. or EMEA, et cetera, their suppliers are global. And therefore, you really have to ensure you're meeting the needs of all of them and providing solutions that will scale, but also meet the needs of shoring up the supply chains. Absolutely.
Okay. And then if I could bring in Rob for a minute, one of the talking points, and we'll go into a bit more detail about this later on, but one of the real patterns we're seeing at the moment in supply chain finance is the use of emerging technology. Are all regions showing the same kind of appetite for the use of technology, or does that differ depending on where in the world you are?
No, I think it is pretty general. It's across the globe. But it really comes down to the amount of appetite. I think everybody's showing appetite to move digital, right? Everybody's showing appetite to remove paper from processes today. Everybody's showing appetite to ensure that they can connect to as many of their supply chain ecosystem as possible. However, there are different areas in the world that are actually accelerating faster than others. And I call out Asia for a moment. This has been amazing what's happening there right now, and the move to digitization there. So it's not, I think, what the objective of moving digital is global. The pace in which you move digital and how you do it is very regional.
Okay, so what are some of the factors that have made Asia, to cite your example, different in terms of rate of adoption?
Well, I mean, this is a guess, right? I mean, if you think about it and look at particularly cross-border trade in Asia, it was predominantly letter of credit, right? So, what we're hearing is that a lot of large exporters and importers are not prepared to rely on paper documents anymore. So they've got to look at different ways that they can, risk mitigate transactions, and you look at the continuous supply of goods, financing opportunities, risk, everything that they were doing, which was in a letter of credit construct. Now, obviously, as you know, there are various projects such as Contour, etc., to move letter of credits digitally, right? But there are other alternatives as well that may be used to look at this risk mitigation process and the ability to match data and actually agree on match data, creating an outcome which risk mitigates the actual transaction in a very similar way to what BPO tried to do about 10 years ago, but now doing it with new technology that allows that to scale in a more pervasive way. So I would say, just to answer, I guess the direct answer to your question is that I think Asia really was kind of forced to do it. It's sort of like, why cell phones and e-commerce and payment systems in Africa more pervasive there than anywhere else? Well, because they had nothing to start with. So that's from where you came from, I think.
Excellent. Okay, thanks. I think Dominique should be back with us now, possibly dialing in rather than video. But Dominique, are you able to tell us a bit about, from your perspective, the differences in terms of different regions and the provision of supply chain finance, how that varies by where you are in the world?
Yeah, actually, yes, I'm back. I'm sorry for the issues. So we have differences between some regions. In more advanced technology, maybe in the Americas, less advanced in, let's say, in Asia, where we have diverse technology, diverse system. In Brazil, some development with a monkey. In Europe, we have also some interesting initiatives to develop facilitate supply chain finance programs. We have government-supported also pushing the development of technologies, helping the companies to launch supply chain. Like trades in India also. I would say that in Europe and US, it's more private initiatives. So lots of different solutions which will push, in any case, banks and corporates to adopt new technologies.
That's great, thank you. I think the sound's still a little bit patchy, Dominique, but I think it's a lot better. I think we caught most of what you said. Okay, well I'll move on.
I have an echo, so it's not easy.
Yeah, sure. Yeah. Okay. We'll talk a bit now about some of the challenges with current solutions. So, Dominique, if I could stay with you for now, what are the main challenges that financial institutions face, or that corporate clients face, when implementing and managing supply chain finance programs? If Dominique isn't connected now, can I just put that question over to Anne instead? Anne, are you able
sure.
to? Thank you. Yeah.
Yep. Happy to, John. Thanks. I would say supplier onboarding is number one. There's a lot of process there, bringing all the suppliers on, being able to scale the solutions. I mean, the program's only as good as you get in the uptake of the suppliers. So, there's often a time lag there in onboarding of the suppliers. So, to really looking at managing the regulatory, the documentation requirements, that are required to onboard them. We're also, from a bank perspective, of looking at different options on how to better streamline that to get accelerated benefit to the buyer, and from a working capital perspective, getting suppliers on board and going deeper. We have, just introduced an internal tool that will help by using AI and some data analytics around, what are who are the most likely suppliers to accept, so you can get those in the queue faster, et cetera. But I think if you read anywhere, and I know our peer banks, it's the same challenges. If you can really crack the automating of onboarding of the suppliers, then that's a significant challenge to overcome, and that's something we're investing a lot of time in.
Right. Okay. And is that another one of those challenges that probably varies a lot depending on where you are in the world or the kind of supplier profile that you're dealing with?
Exactly. The regulatory requirements vary jurisdictionally, and so you have to, and so the suppliers are in across the globe. So there's a lot of analytics now available and data around prioritization of the suppliers. Be it that the most strategic that give you the best information out of the gate, all the way down to what industry they're in, how likely they are to want or need the financing, as well as whether there are existing clients, et cetera. So I think there's some of the emerging technologies are starting to really provide opportunity that I think will really transform the ability to grow supply chain finance programs, particularly on the onboarding of the supplier side.
Great, thank you. We're going to go back to Dominique. I think the sound problems have been resolved now. Fingers crossed. Anyway, Dominique, would you be able to give us your views on some of the challenges facing both financial institutions and corporates when implementing supply chain finance programs?
So, can you hear me?
Yep, loud and clear.
Okay. So, just your question was on the. Please remind me the questions, just because I had a double.
Yeah, of course. So, what are the challenges for financial institutions and corporates when implementing and managing supply chain finance programs? Okay, so the challenges is really to agree with the client at the outset on the targets. Are we really in line on the targets? Does the client want to improve the working capital? Does the client want to help their suppliers? Or does the client want to improve its image, the reputation, and do the program for sustainability? Then, when everyone is aware, the client will have to align internally, treasury, accounting, and procurement to make sure that everyone is going in the same direction. Then I would say that for the bank is quite easy to implement the project when everything is really engaged and there is a real willingness from the CEO or the CFO to implement the program. Then, when managing the program itself, of course, main issue will be to have a smooth supplier onboarding, which is really key for the success of the programs. For that, we try to automate as much as possible the suppliers onboarding process, have a lightened KYC process for suppliers, and at Crédit Agricole we have succeeded in having some very simple requirements from compliance to onboard the KYC suppliers. And now we are going, thanks to the COVID-19, which has pushed the electronic signature, we can sign online the documentation and facilitate the suppliers onboarding. So say that from the moment the client is willing to implement a program and the moment we manage it and we onboard suppliers, so with lots and lots of suppliers on the platform, it's between 2 and 6 months maximum, depending on the size of the program. That's great. Thank you very much. Rob, so supplier onboarding then, automating and using technology to make that whole process more efficient. How far along that journey would you say we are at the moment? And are there issues there around how inclusive supply chain finance offerings are?
Yeah, so two good questions. I think as far as supplier onboarding goes, it wasn't so much a technology issue before. It was really a compliance and different requirements from various banks as to how they would actually onboard these suppliers. When we go back and when I first started, develop Prime Revenue years ago, it was, they were basically onboarding suppliers as if they were a customer of the bank, opening a bank account, getting a loan, et cetera, et cetera. And obviously the degree of KYC that's required for supply chain finance should be very different than if you're building a customer relationship, a full customer relationship. And many, as was stated by Dominique and Anne, a lot of this has sort of moved along since then. There are ways in which now banks look at various levels of compliance required to onboard these suppliers. However, notwithstanding that, you've still got to make it really simple and easy for the supplier. You've still got to know who you're dealing with. You've still got to be in a position to make sure that the data that you have on that supplier is correct and accurate, right? And more importantly, that's got to be continually maintained and updated, right? So technology has a massive role to play in this going forward. Once the compliance is sorted out. And again, I do agree that COVID-19 has really been a catalyst to accelerating this. We actually obviously truly believe that using a blockchain technology and actually creating a verifiable digital passport of the participants that are on any network and having that validated continuously against different data sources in different countries depending on the jurisdiction of the supplier really does help this process massively. And to make that totally visible and independently verifiable, it really takes us a step forward. So, again, technology has a tremendous role to play here, but it's together with, looking at compliance organizations within the financial institutions to move along with the available tools to them. And that's starting to happen. So, my vision is, my view is that we won't be talking about supplier onboarding within the next, probably 3 or 4 years.
Fantastic. Okay. And I'll stay with you, Rob, actually, because I wondered maybe if you could give us, you mentioned already the use of blockchain, but I wondered if you could maybe give us a quick overview of the kind of technologies that are being talked about in terms of supply chain finance and the sort of impact those might have.
Yes, so I mean, thank you for that question, because that's really right in our wheelhouse. The reason that we actually did start Marco Polo and obviously created and built the technology around it was because we saw a real shift in 2014-15 into technologies that we felt could actually truly create an interconnected world of information that would flow and be, basically immutable and verifiable. So therefore, there were 4 key technologies that we believed really truly impacted, what we needed to build in the future to build this. Actually, believe it or not, cloud is actually probably number one. But they all fit together. So, and to be in a position where you can build applications and platforms that actually are independently run with their own data set, et cetera, not in a SaaS environment, but and being in a data center that is based on the jurisdiction of the supplier or the buyer, for example. Look at things such as data residency. Be able to scale that. That's another big challenge. How do you scale that so you can go from a single participant company to a multinational company? It's very, very difficult to scale down. It's not so difficult to scale up. And then, of course, to bring this all together, we needed to work out, well, how is this going to really work? Because we don't want to have a centralized database anywhere, because this clearly is not going to, it's going to create a single point of failure. And then how do we deal with things such as privacy and security? So therefore, in comes blockchain, or distributed ledger technology, as we call it. And if we couple the two things together, we thought we really have something to build on at this point. But as you know, BLT and blockchain is a new technology. So it was not very mature when we started out in 2000. Well, we actually started out experimenting with everything in 2015. But when we look at it in 2017, when we really started developing, we've had to grow with the technology. And more importantly, we've had to grow with the technology to actually be deployed on a multi-cloud infrastructure globally, which can consume a minimum amount of CPU so that we don't get into huge cost to do this. Because this is not a software as a service network. This is basically, you're running your own application on your iPhone, for example, iOS. So the supplier is doing exactly the same. The buyer is doing the same. The financial institution is doing the same. The insurer is doing the same, etc. And then, of course, we needed to connect all this to the back office. So, obviously, the use of the building an API-centric architecture to allow banks and anchor corporates, large corporates, and even small corporates that actually want to be able to interface to things like Xero or QuickBooks, for example, to give them the ability to do it. We needed to go from their view to the world to the view backwards, and therefore APIs and RESTful APIs were really important to us. And then the last piece of technology, which is now starting to be used more and more as we are developing, is around machine learning and artificial intelligence. And the area that we're applying that to first is obviously the supplier onboarding and validation of different data sets and making sure that the supplier is who they say they are, etc. But there's many, many applications for that as we start to grow as we go forward. But they were the four technologies, if you like, the four pillars that we felt could really, really change the way in which these siloed applications were delivered traditionally in trade and trade finance globally.
Right. Okay. Thank you. So I guess that paints a picture of a mix of technologies, some of which are quite mature, relatively speaking, and some of them are still very, very much nascent. I wondered if I go back to Anne and ask, when we talk about technology, what kind of solutions have you already implemented in your supply chain finance offerings at the bank?
Have implemented a new tool for the onboarding of suppliers that gives data analytics and predictability, AI, as well as a portal for the buyers as well as the suppliers. But when we're looking at our technology, we also look at what are the clients looking for. And a lot of times clients are looking for third parties. So as part of the Marco Polo Network, so we're excited to join there, is it gives our buyers options, and we're providing the credit, etc. So as part of the Marco Polo Network and some of the work we've been doing with Rob and his team, really looking at the blockchain part of it, but really the streamlining piece of that. It's an interesting model around with the ability with the digital distributed ledger is that, as Rob just said, the buyer has his own node, the supplier has their own node. From a security perspective, it gives you just a different level on that, as well as the bank being able to offer to the client, multiple solutions. And so we're excited about partnering with third parties. At the same time, we certainly have proprietary platform that meets the needs of a lot of our clients, and we continue to do upgrades on that to ease of use, etc. Looking at AIs and so forth. We're seeing definitely more clients looking for AI solution. Data is king, whether it's the ability to accept the data inbound or to send them additional data outbound. So, we're kind of looking at this holistically. What do the clients want? What technologies can support that? And I really think it really evolves around how do you best leverage the data and provide the solutions to the client using these emerging technologies.
That's great. Thanks. And I'll put the same question to Dominique, if that's okay. Dominique, how excited are you about the use of technology in supply chain finance? What are the benefits you see?
As of today, in terms of implementation, we have mainly worked on AI and smart data to help the suppliers to have predictive models, anticipate their utilization. We are also focusing on API to connect our system to the client ERP So as Anne, we think technology is only useful if it helps the client. Definitely, connectivity is key, and more and more we want to have systems integrated to the ERP of the client. So we are working on that. Maybe also we have been focusing also on the connection to our own payment engine. See supply chain as a flow business, and we want to be able to handle volumes, able to make payments very smoothly to all the suppliers. The system is fully integrated, and in terms of technology, of course, we will benefit from the new developments in terms of payments. So let's mention ISO 20022 format, which will bring a lot of information to the supplier and the buyer, enable the reconciliation of invoices. So it's really important. And instant payments, which is also developing, which will accelerate the payments to the suppliers. At the moment, we try to be very practical and pragmatic for our clients, and also looking, of course, blockchain as a mean to increase the safety of those transactions. This is why we are also looking at all those DLT solutions in the market.
Excellent. Okay, thank you. Rob, you touched on inclusivity in one of the previous questions, and how technology could help. Would you mind explaining a little bit more about how new network offerings can help supply chain finance offerings in terms of inclusivity? That one's going to Rob, if that's okay.
Yeah. If we can talk about two things that really are important to us. One is that if you think about traditional supply chain finance, it's always been a big to big, large suppliers to large buyer, and really nothing really happened in the middle or what a lot of people refer to as tail supplier place. So we needed to build a technology which basically allowed anybody, doesn't matter who they are, to be able to join the network and be able to interact with their customer, being the anchor buyer, for example, in a procure to pay flow. And basically, the technology to do that means that you need to have automated onboarding. It means that you need to be in a totally digital and automated world. You need to be able to verify that who is at the other end is indeed the person that's at the other end, right? So this is where using blockchain technology, positioning it on a multi-cloud infrastructure globally really affords you the ability to do that, right, going forward. So, but, I just want to call out, before even COVID-19 was happening, we were getting a lot of inquiries from companies and large buyers with our banks that were looking at this as part of their ESG strategy, at the sustainability of the supply chain and the inclusiveness of the supply chain for the social aspect of ESG, the governance aspect, making sure that they could actually sync at real time the digital passport on the network with their vendor master files. So that was always in sync. And we all know that a lot of companies have a lot of difficulty managing vendor master data going forward. So all of these things sort of add to a value proposition for the buyer and a value proposition for the supplier. And then if you layer on what Dominique was talking about, a lot of our banks, they want to do what payroll services do for payroll. They want to just pay. They want to provide services to pay everything, every supplier, no matter whether the supplier asks for early payment or not. And to do this, you can't assume that that all suppliers are going to be equal, right? You're not going to go and move terms for middle market and small suppliers if you're a large buyer. That would be suicide in the press. But to give them all these services, if you're going to get a benefit by streamlining your payment processes, reducing risk by not carrying bank account details because they're carried on the blockchain and you can always get the information when you need it, all these things add up to a real net benefit to the buyer. And these are the things that our banks are seeing right now, is that it's actually a more integrated and actually a more pervasive solution that this technology can actually deliver to the buyer and the supplier. And it's not just purely financing. Financing is a great outcome, and it's obviously right now really needed, but there are a lot of other things that can actually be delivered to that buyer-supplier relationship.
Great, thank you. Now, I said we leave as much time to get to questions as we could, and understandably, and probably not very surprisingly, a lot of questions that we've had already have been related to technology. I think it probably makes sense if we stay with Rob for a bit. We've had a couple of questions come in around Marco Polo itself. So, Rob, maybe it would be helpful if you could just talk us through who Marco Polo is, what is the offering, and what are the main differences compared to other supply chain finance solutions out there?
Thank you. So Marco Polo was actually founded by 12 banks originally, ourselves and R3, which obviously produced and developed Corda, which is the underlying blockchain or distributed ledger technology we used. And then as we started to understand what we needed to deliver and how we need to deliver it, we went on a journey with these 12, and then eventually this grew to more than 30. Actually, I think it's closer to 40 banks now, and more joining. And also a number of their corporates at the same time that were prepared to test it, were prepared to look at piloting it. And the reason we went through 2 years of testing, piloting, etc., is because we needed to get the technology right. And we did have a couple of pivots on technology. There's no doubt about that, because we needed to get it to scale. We needed the performance to happen. We needed to be able to do 30 million records on a distributed ledger, that's live, active across one entity. So if you multiply that by five buyers, this could be, could actually scale massively and massively quickly. We needed to be able to make it robust from a security point of view. We needed to deploy it fast, and we needed to deploy it in multiple jurisdictions. So working with the banks and the banks that have supported us has been really, really important. Working with the corporates that have tested it with the banks has been massively important. So Marco Polo is a collective of like-minded institutions centered around the banking industry that wanted to deliver a more pervasive technology to look at procure to pay, which is you were calling supply chain finance, look at risk mitigation, which is looking at all digital alternatives to letter of credits, basically. And thirdly, then starting to look at the order to cash cycle. Obviously, we're more centered, even though we delivered order to cash first, we did that for a reason, because it's more of a one to a few relationships. But if we think about procure to pay, it's one relationship to thousands or tens of thousands in many cases of relationships. So, the network right now is up and live with the payment commitment, which is the risk mitigation, both 3 and 4 corner model, and with receivables discounting. And payment and where we're going with what we call supplier pay, the first version of that goes live in October, and then we've got rollout plans through the first quarter of next year, which will allow us into some really, really fantastic features that will differentiate how the value proposition is delivered to buyers and suppliers going forward. So TradeIX is the builder of some of the technology that's on Marco Polo, but we're actually just partnering right now with a number of other software providers that are building, for example, an insurance app that's going to go live. We have a partner that's building an SAP connector, which is really exciting because of the way that's actually being constructed. And we have also partnerships that we're developing with people like Bolero and Estox, which are developing their own connections onto the network as well, so customers can consume information that they have and produce requests to them. So it's not just us building; it is actually starting to happen. We're getting more and more people starting to build applications that will sit onto the actual network itself.
That's a great overview. Thanks. If I could go over to Anne and ask maybe for a bank perspective on the Marco Polo development. So, from a bank's point of view, what would be the potential benefits of an initiative like that?
Yeah, so I hit on it a little bit before around, the ability to deliver solutions to clients that really add value or that augment our own particular solutions or fill current product gaps. I mean, we look at fintech partnerships like that. We spend a lot of time having to do regulatory changes, et cetera. Part of being a bank, you spend a lot of investment dollars on regulatory changes on the platforms, et cetera. Fintechs have a little more flexibility than banks do, less scrutiny on that, and therefore can potentially deliver solutions to the market faster. So what we liked about the Marco Polo platform in particular, because we looked at a lot of solutions, is really flexibility, multiple products on it. Rob just spoke of that, and the ability to scale and go down market for smaller buyers and as well as suppliers, and really be able to enhance the offering that we have across all our markets, and really having a good partnership. I mean, ultimately, we spent a lot of time looking at blockchain from a trade perspective at the bank for the last 5 years or so, and it's maybe not where we wanted it to be in 2020 yet, but it's still heading in that same direction. And these solutions, what they do is allow interoperability too with other platforms, et cetera, that if you have standalone bank solutions, you're limited in that. So really looking across, it's being able to provide a suite to the clients, picking solutions from third parties that can meet those needs plus, and then staying, really relevant in the market and moving fast as things change, emerge, be it regulatory or just the technologies that continue to evolve.
And actually, you mentioned a changing regulatory environment. We've had a few questions come in around the kinds of conversations companies are having with regulators in various jurisdictions around the use of these kinds of new technologies. How much of an issue is that the regulation question? Do you tend to encounter legal barriers, regulatory barriers, or generally are regulators quite open to these kinds of things?
When we first started looking, blockchain in particular had a lot of really openness on the regulatory side, governments, because it creates more security, it creates better auditability and traceability, and then with the interoperability, I mean, we talked to some, Asian governments around the ability to track goods and so forth, and so there was actually a lot of positive excitement from a government perspective on some of these new solutions that will give them greater transparency. We have to still look at, then there are also a lot of regulations around data privacy and what you can do with the data and so forth, and that's continuing to evolve. So, but if you have your solutions in like a blockchain where things can stay on nodes, those solutions tend to be easier to be able to comply with. So, that's kind of where we see the space. Banks are still going to have more scrutiny at this point. The fintechs get a little bit more leeway on it, but some of these technologies are going to help with an easier way to comply. On other fronts, we're probably going to deal with some challenges. We certainly have an infrastructure at the bank that is constantly, looking to ensure we don't have risks in our technology. You don't have holes for breaches and data and security and all of the cyber components of it. But that thing is really playing out in the market where there's some advantages to some of these technologies to actually help with that.
Great, thank you. And Dominique, there's a question which has come in, which I wondered if I could put to you. It's around the impact of COVID-19. So going right back to the beginning of our conversation, the impact of COVID-19 on the use of digital signatures. So this probably ties in a few of the things we've been talking about today. Are you able to talk a bit about the impact of the pandemic and how it's changed that whole environment around digitization?
Yes, definitely. So it is true that we had, it was one of the main benefits, I would say, downside, but at least the benefit has been that we have been pushing for some digitization of services within the bank. We had some projects globally for the bank. COVID accelerated the implementation of across business lines within the bank. So, of course, I know there are regulations issues in terms of countries where the signature will be available or not. So we started with France, UK, and we'll deploy it across the countries. At least we have the support from legal compliance on this, which was not easy to get. The project has been launched, and the first results have been really executed, and some business lines can already using it very easily. Major progress and good improvement for our clients, obviously.
Great. Okay. You mentioned some of the legal issues potentially internally, but have you found externally? Have you found regulatory bodies have been quite open to this shift, especially given the unprecedented times that we're living through?
Absolutely, and we see an openness of various governments to facilitate the business. Main priority will be to sustain the economy and help the companies to redevelop. So definitely, we have a positive ear from the government to help on the legal and compliance side.
That's great, thank you. Rob, there's a couple of questions which, if it's okay, I'd like to turn over to you. One of them continues on this theme of regulation. We've had quite a few questions come in around that area, and it's specifically related to anti-money laundering risks. So I wonder if you'd be able to talk a bit about how providers of supply chain finance can ensure that compliance with anti-money laundering requirements remains in place as this kind of as offerings become more inclusive and a wider range of suppliers kind of come on board. And then I'll stay with you afterwards, and I'll ask a couple of more practical questions. But yeah, the AML one first.
Sure. So just to be clear, what we do is we assemble a payment instruction file, and Overchain actually deliver that to the transaction bank that needs to execute on it, right? So, and that's delivered. Hopefully, the bank will take that as an ISO 222 message, as Dominic alluded to before. But we can, and we do, in fact, provide another layer at the beginning. It's not necessary. It's not even viewed by some of the regulators, but it's seen as extra. Because we're always looking at the digital passports of the constituents or the participants on the network, right? And we're validating against various data sets, right? If something changes, we can alert directly, and we can alert, particularly if it's we see that on a OFAC list, for example, or some sort of sanction list. We can actually, create our own alert to see whether or not it was a false positive, et cetera, et cetera. But again, just to be very clear, what we deliver to the bank, even though we may have done that, the bank still has to do their own checks, which they do, right, to actually execute the actual payment going forward. But I do think this extra layer actually will become more and more important. But what it does for the corporate, right, is that is also communicated back to the anchor buyer. So therefore, their vendor master data can always be updated and always in sync, which very often is not. In fact, most of the times is not, right? So they're getting that extra piece of comfort knowing that we're always checking. Now, certain things we don't check for, because we don't check negative news in this part, because obviously it's unless the buyer wanted us to do that, we could. It's just an extra cost. So I do think, we do need that extra layer. But again, just to be very clear, the execution of the payment is in the domain of the transaction bank that's actually executing the transaction. They have to conduct their own AML checks.
That's great, thanks. And a more Marco Polo specific question on the practical side. Could you tell us a bit around the network's presence in emerging markets, both kind of at the moment and then looking a bit further ahead?
Yeah, this is a really good question. So we, not so much on the supply chain finance side at the moment, because obviously, that's to go live, but on payment commitment, some of our biggest projects that we're embarking on right now are in emerging markets where they are producers, particularly of commodities, and these are obviously soft commodities. And in fact, we will be announcing a pretty exciting alliance with a certification body, which will go online. We're going to do that in conjunction with a very large cloud-based cloud provider, and this is going to give us the ability to actually look at things like sustainability being brought into the delivery of those, or the originating farm, being able to look at ways of injecting people like the IFC into the transaction for the banks that are in those emerging markets. So, emerging markets is really a very important part for us, particularly when it comes to payment commitment. And we really see great opportunity there, because emerging markets are generally new adopters, the early adopters of new technology, much faster, and that's been proven through cell phone adoption, payment adoption through mobile phones in Africa, I alluded to before. So it is a big area for us. Now, obviously, because we are deployed on a multi-cloud infrastructure, it's very easy for us to be able to deploy into a lot of different countries that have different jurisdictional data residency issues, right? And actually make sure that the data stays in that country, because, or the supplier's data or the buyer's data, whoever they are, banks, for example, is in the country of residence because of the restrictions that apply. A lot of emerging market countries have these restrictions, right? So I think we've got a lot of opportunity in emerging markets, and it's something that's really near and dear to my heart, and actually my team's heart as well. It's something we're really pursuing aggressively, and I think over the next sort of 6 to 8 weeks, we'll be putting out some pretty interesting announcements on that.
Exciting. Okay, thanks. We've got loads of questions still coming in. So I think we're going to run for another maybe 10, 15 minutes or so. So we'll just get through as much as we can. Do keep them coming in, and we'll try and get to them. We'll try and get to as many as you can. So I think maybe next time I'll go to a question which relates again to what we were talking about right at the beginning of the call. Dominique, the question is, in terms of the impact on supply chain finance, how do you see the difference between the 2008-2009 financial crisis and today's situation with COVID-19? Are there similarities there and are there differences there?
Well, I think the current crisis is really emphasizing the need for stable assistance of the SMEs market. We have seen the growth of supply chain finance, existing programs being more and more utilized, because this crisis seems to be really very hard, and also companies have realized that this tool can be really used to assist their suppliers, to help them getting some liquidity, and for the buyer to have some payment terms. Nobody's penalized too much. So really, we today in sectors like aerospace, so tech data, some need really to using working capital tools and involve more and more suppliers. A new trend also is to try to go earlier in the chain, which means how to include not only accepting invoices, but also purchase orders, so that the production can continue even if the invoices have not been issued, but suppliers can have some treasury.
Sorry, Dominique. Sorry to interrupt you. I think just in the last few seconds, I think your connection might have become unstable again. So we've missed the last few things you said there. Do you want to try again? Maybe repeat just the last thing you said. I don't think it's going to work. Should we? Okay. Well, let's give you a couple of minutes.
Maybe it's working.
You can come back in. Do you want to just try one more time? Just repeat.
And so I was just mentioning the purchase order financing. And some governments, like France, but also I think US Exim is looking at it, will provide guarantees to the banks to cover a portion of this risk, because of course it's a different risk, including performance risk of the.
Great, thank you very much. We've got a slightly different question as well that's come in, and maybe Anne, if I could send that your way. We've heard a bit around the different provision of supply chain finance by the traditional banking sector, the fintech sector. How important is low cost of capital when offering supply chain finance, and are banks uniquely advantaged in that respect?
Yeah, I think banks are definitely advantaged in that, just relative to, the credit facility, et cetera. I think it's why there's, different products will emerge in the market around like dynamic discounting, et cetera, that has less of dependency on the banks. But I do think it's why there's a good partnership now with banks and fintechs, because both kind of bring a certain ability to execute on their own, unique set of what they bring to the table. The fintechs being able to deliver solutions faster per se, but lack, the ability to do the capital and the credit. And then, at the end of the day, the relationships with those corporates, they trust their financial institutions. So I think it's really a marriage of the fintechs and the banks to make the solutions work in a environment that really requires the trusted relationships as well.
Excellent. Okay, thank you. And Rob, we've had a few more questions come in looking at Marco Polo specifically. So first of all, a question: is there any way of using trade credit insurance as a risk mitigant on the platform?
Yeah, at the moment, as I alluded to before, we have a company that's building a trade credit insurance app that will sit as a node, so it will connect to different brokers or trade credit or underwriters. So we would say that, at the end of the day, we're not sure of the actual date that will actually be available, but they are actually doing that, and they're working with some of the large trade underwriters and indeed brokers as well. So the expectation is that absolutely there will be. And in fact, if you think about insurance, it's fantastic for the industry, because you actually can have actual underlying invoices actually verified and validated against policies right up front. So it is insured, because the insurer or the broker has validated that on the blockchain to say, yes, this is insured, and it fits within the limits that they hold on the underlying buyer. So, it's actually very exciting, but we're really excited by this. We will not be building it. We're agreeing on the flows and how it works on the network, but it will be built by somebody else, and it will work on Marco Polo with all of the applications that we've delivered.
Mm-hmm. Okay, and a tangentially related question in that it relates to risk. Could you tell us a bit more around the connection on the platform between trade documents and actual goods?
Yeah, good point. So we look at data, not documents, right? So there has to be the data, there needs to be a metadata layer, but we are actually bringing in the ability to bring attachments onto what we call the node, and to be stored and then validated. So if anything changes, you'll know it's changed. So we will do that, but the actual matching is all done, and validation and verification is all done through data. So at the moment, what we have is we have a three-way match, which sits between a buyer, supplier, so purchase order, invoice, and information coming from a logistics provider. Now, at the moment, that information is predominantly around track and trace information that's provided independently. But we are now expanding this to look at e-bill of ladings coming on. We have a partnership which people know about with Purple Track or Polestar, and we are doing vessel geolocation through IMO, through the IMO of the vessel. This has other things around compliance attached to it, which is really quite exciting. So our goal is to bring more and more points of validation and verification of the underlying trade. And again, going back to your AML question, this is really, really important, because if you can actually show the provenance of the trade right through to the actual payment that's been made, that's exactly what the regulator wants. That's exactly what the banks want. So, again, our goal is to bring and create many, many on-ramps onto and off of Marco Polo for these providers.
Right, and presumably that ticks several boxes. So AML, as you mentioned, but also presumably around sanctions, around fraud.
Correct. And look, if you just think about what happened in Singapore with commodities, the whole blow up of commodities, I mean, some of this would not have happened if you had third-party, multi-party verifiable data and matched against it. It would have been impossible for that to happen. So if they used the data that was on the platform, obviously you could still take a document off not on the platform and go somewhere else with it, and maybe somebody will finance it. But this was a much better way to do it. So we're super excited by the partnerships that we're building and giving everybody the opportunity to build their own, their own business case for being on the network, and not trying to get in the way of doing that, but supporting it.
Great. Okay. And one last Marco Polo specific question, if that's okay. Are there any sectors that Marco Polo policies won't deal with? And the example given in the question was the defence sector.
Yeah. So there are prohibitive goods. There are goods used for arms, etc. So there are a number of them. There's also the sanctioned countries, sanctioned individuals that have beneficial ownership or have any ownership or stake in a company, sanctioned companies, etc. So yes, they are, and this is why the data matching and many databases that we go against to validate and make sure that the underlying party is first acceptable to the network and can come onto the network. And by the way, the other thing I should say is that all of the banks have agreed to a governance model which allows us, which we follow, to allow a party to actually join and become a participant. And then it extends right down to a single person entity that could be providing janitorial services, as dumb as that might sound. But that is really the sort of rigor that we place on onboarding onto the network. The second thing is obviously the underlying commodities that are actually shipped. Again, a lot of this comes down to the bank, buyer, etc. But obviously we've got to match that data. We've got to be in a position where that data is made visible to the counterparties, and they're able to know what is actually in the actual shipment itself. So, one of the hardest things we had to do was actually build in, and this has not been delivered yet, is the actual full line item, going down to a single line item and doing very, very detailed line item matching has been something that we have had to adopt into the actual into the network for payment commitment. But we also think this has application even in supply chain finance going forward. So a lot of what we're doing on one module, one area, actually is as a service can be delivered into another area of the network going forward.
Great, thank you. So we are almost out of time, almost out of extra time, in fact. Just before I hand back to Stacey, I thought I'd just ask each of the panelists one last question, just relatively briefly. I'll start with Dominique. But I'd like to hear, same question to all three of you. What do you think will be the single biggest change in terms of supply chain finance in the next, let's say, 3 years?
Well, the biggest change for me will be to offer more possibility, more options to the client to use new solutions. I think the biggest improvement will be to have a smoother implementation increase of the STP processing, that more suppliers, including SME suppliers, can access to supply chain finance. Marco Polo will be one of the solutions, but there will be others, and the combination of those solutions will help supply chain finance becoming something quite easy to implement, a commodity like DLC today, but much more electronic and much more automated than.
It's great. Okay, more offerings, more suppliers, and easier to implement. Anne, if I could ask you the same question, let's say the next 3 years, what do you think is the biggest change we're going to see in supply chain finance?
Yeah, so I think there's, I would say on two fronts. One front would be, along the lines of where Dominique was, and efficiencies and so forth. But I think that would be driven by some of the technologies, including the ability to kind of interconnect the whole ecosystem of where the goods are at, so forth. Probably be able to speed up that whole process around the supply chain side of it, which will create efficiencies, more straight through processing, and really the ability to interconnect other products for supply chain financing. So you go from an open account to a supply chain financing after, all of the PO matching, et cetera. So more automation in the overall process. And then the second piece, which is kind of an interesting piece now where we are in 2020, is that there has, been over the years a lot of scrutiny around, the accounting treatment of, is this bank debt for the buyer, et cetera, that keeps cropping up and so forth. And, at the end of the day, the buyer has the liability to pay that supplier. Paying him early just strengthens the whole global economic supply chain cycle. And so the pandemic may put more light on the ability of what supply chain finance can do overall to shore up the supply chain in times when, you have economic challenges, be it a pandemic or a financial crisis that you mentioned. So I think those are the couple of things that I would say, are high on the radar: automation, technology, and then maybe we finally can settle the accounting treatment for supply chain.
Okay, that's an interesting point actually to bring up, because I suppose some of the issue or some of the concerns that were raised were what happens in an economic downturn, and I suppose now we're realizing what happens in an economic downturn, and actually it looks like supply chain finance is bringing really important benefits to both sides of the transaction. Rob, exactly. If I could just ask you the same question: biggest change over the next 3 years that we're going to see in supply chain finance, and then I'll hand back to Stacey.
So I think it's going to be full digitization. It's going to be transparency. It's going to be sustainability. It's going to be security of the transaction and the visibility of which is the transparency, and that's going to lead to greater opportunities to offer better and more financing opportunities, and actually more services. The bank I think banks, a lot of their transactional cash management services will actually start to merge into how they give a better a turnkey solution to large buyers, right? So the differentiation between payments and trade finance is going to sort of blur a little bit going forward, and that's all going to be led through transparency and the digitization of these relationships between buyers and suppliers.
That's great, thank you. So that's all I think we've got time for. I'd just like to thank Rob, Dominique, and Anne for their time, and just hand back to Stacey. Thanks everyone for tuning in too. Bye-bye.
Hello everyone, and thank you for staying with us. I want to add one point that I think that we're going to see more of in the future, and I think we're going to see a lot more interoperability across platforms, and that's going to make it even broader and better for the industry in general. I want to say thank you to our co-host Marco Polo, I'd like to say thank you, very strong thank you to our speakers, Robert, Dominique, and Anne, and a special thank you to John for fantastic moderating. It was a challenge today with across the various entities and folks who are speaking, and so I think you did a yeoman's job of bringing it all together. And thank you very much to all of our attendees. We appreciate your participation, and thank you all from BAFT for joining us today. And we'll speak with you again soon, I hope.